There are major changes coming for investors in 2026, and some market analysts believe that these changes could bring new opportunity and possibly the best chance for investors to make money. Depending on your situation, one or all of these could directly impact how you invest. So, what are the major changes happening right now in the investing world? You might hear all kinds of fancy words being thrown around like tokenized stocks, Trump accounts, SEC rules changes, and all of that. But don't worry. I'm going to walk you through what exactly it means in plain English. In this video, we're going to talk about why these analysts and investors are excited right now, what is actually changing, and how you could possibly take advantage of it by focusing on what really matters in the long run. And this is often the most overlooked thing by most investors. All right, so there is something really interesting happening behind the scenes right now, and it could change how a lot of everyday people invest. According to a recent report, the SEC, that's the group that helps keep the stock market in check and the one that ignored Bernie Madoff for years, is looking at getting rid of one of the biggest rules that's been around since the early 2000s, the $25,000 day trading rule. Now, if you've never heard of it, here's the deal. Right now, if you want to make more than 3 quick buy and sell trades in a 5-day period, you've got to have at least $25,000 in your account. That rule was put into place after the dot-com bubble popped to keep inexperienced investors from getting in over their heads. But the SEC is reportedly thinking about removing it. And if they do, it means that a lot more people, especially smaller investors, could start day trading without that $25,000 hurdle. Now look, I don't believe day trading is bad. In fact, on another channel of ours, we teach day trading. I have several friends who are very successful day traders. I laugh when I hear value investors criticize day trading when I've literally seen people do it very well. But I'm saying it's risky if you're doing this without the proper approach, proper technical analysis, and a process that works. I've never seen anybody do it successfully who just went in there and said, oh, this stock is going up, let me buy it. They look at signals, they look at trends, they look at charts. Most people think it's an easy way to make fast money, but it's not. Usually it ends up being a fast way to lose money, especially in a market like this one, where prices are sky high, emotions are running hot, and volatility is up and down every single day. This is why I always talk about principle-driven investing on this channel. You don't need to chase charts or jump in and out of stocks to build wealth. Quite the opposite. You need to understand the business when you're buying it. And when you own a stock, you are now a part owner in that business. It's not a ticker that moves up and down or a betting slip. You need to focus on buying great businesses at great prices and let compounding do the rest for a long period of time. So while this change might get some people excited, just remember, the best investors out there, as they built their wealth, didn't jump in and out of stocks. They built wealth slowly by compounding over time when a stock grows its revenue, profits, and generates free cash flow. But more importantly, they bought when the price made sense. I am not a conspiracy theorist. I will say I'm wondering, why is the SEC removing this rule? Well, first off, if the rule was in the early 2000s and 25 grand, it should be adjusted just for the fact that, you sit there and have inflation. But they're not talking about increasing it. They're talking about getting rid of it. So of course I wonder, do they sit there and worry about the market and where it's at? And they want to get more momentum into it, more volume into it? That could be it. But how many people really receive this kind of warning in their accounts? I don't know. But the bottom line is, if they want to get rid of it, get rid of it. At the end of the day, the markets will end up doing what the markets will end up doing in the long run, no matter what, in my opinion. Because remember, in the short run, stocks are a voting machine. In the long run, it's a weighing machine. So in the short run, if they remove this rule, it would allow for a lot more votes to cause a stock to go up or down. But in the long run, the fundamentals will drive the market. Now, this next change coming in 2026, people believe it could shake up the entire investing world. The SEC, again, is now exploring something that sounds like science fiction. They're letting stocks trade on the blockchain. So, what does that mean? Right now, when you buy a stock like Apple or Microsoft, it trades on the New York Stock Exchange or the NASDAQ. Those are traditional stock markets. But with this potential change, companies could skip all of that and let their shares trade on blockchain, just like Bitcoin. If this becomes a reality, companies might no longer need Wall Street to go public. They could raise money, issue shares, and let people trade, all without the traditional stock exchange in the middle. Now, some companies like Robinhood are already experimenting with this. They're trading what's called tokenized stocks, basically digital versions of real stocks. But right now it's very limited. But if the SEC approves this fully, that could unleash a flood of tokenized shares across the market. The concern is it won't stop with stocks. Imagine being able to buy a tokenized piece of real estate or a private hedge fund or even fractional shares of a startup, all traded seamlessly on this digital exchange. That's where things could go in the long run. Now, as a principle-driven investor, here's how I think about it. Just because something is new or exciting doesn't mean it's worth buying. Tokenized or not, a stock is still a business. What matters is the fundamentals, the cash flow, the balance sheet, the price you're paying. The tech is awesome, but don't let cool tech distract you from the real question. What is the business worth? That's the trap that a lot of people fall into. They chase whatever's new and shiny. But remember our fifth principle, probably the most important principle of our principle-driven investing. A great story becomes a bad investment if you pay the wrong price. Blockchain doesn't change that. We are going to stick to our process. We're still going to analyze companies. The medium in which we use to buy them doesn't matter to us. What matters is what we're buying. And we still buy great businesses at great prices, no matter where they're trading at. Now, with that said, imagine the government. The government sits there, it's funny, people don't remember the early days of Bitcoin when people were saying, you don't have to pay taxes on it. I remember thinking to myself, you think the government's going to let you not pay taxes? And then guess what happened? Suddenly, income taxes. And then it was, yeah, but Paul, it's not regulated anymore. And then all of a sudden, the Bitcoin people were calling for regulation. Do you think that the government's going to allow stocks to trade on a platform that they cannot control? Are you out of your mind? If you really believe that, one of us here is a sucker. And I'm pretty sure I know who it is because you haven't paid attention to history if you think the government doesn't want their hands in everything. That's insane. All it takes is for people to get burned, and then those very people who didn't want the regulation will start begging for it. This is the irony of Bitcoin. This next change caught my attention. And honestly, it's one of the biggest changes to personal finance that I've even seen or heard of in a long time. Congress just passed a new law, creating what they're calling the Trump account for kids. And here's the headline. If your child is born between January 1st of 2025 and December 31st of 2028, they're eligible for a $1,000 gift from the U.S. Treasury. I have 2 grandkids that were born this year. So I'm already looking at that saying, oh, they get that. There's no strings attached. It goes straight into a tax-advantaged investment account in their name. Now think about this. If you simply invest that money in something like the S&P 500, no individual stocks, no gambling, and it grows at the historical average of 10% a year, by the time your child retires, that $1,000 could be close to $500,000. Let that sink in. So, if you're a new parent or planning to be one in the next few years, pay attention to this. The accounts are expected to launch on July 4th, 2026, and more info will be coming on how to open them. Now, from a principle-driven investing perspective, this is exactly what we talk about all the time, because what makes this so powerful isn't the $1,000 itself. It's time. It's compound interest, and it's staying invested in great businesses over the long haul. But when you start early and you stay disciplined, the odds die dramatically in your favor. And this is what's missing from 99% of financial conversations online. Everyone is chasing quick wins. Hype stocks, the next hot thing. But real wealth is built slowly, with patience, discipline, and principle. Now, here's the reason I love this idea. Bill Ackman, he has a great idea. So this idea comes about Social Security. I don't know if you're aware of this. The returns on Social Security since it started have been 1.8% per year, give or take, since it started. 1.8% per year. His thought was this. Every time a child is born, put $8,000 in the S&P 500 for them, and at 65, that's their Social Security. And guess what? It's brilliant. Because think about it. If 1,000 becomes 500, 8,000 becomes 4 million. And at 4 million, if it's going to last them 30 years and you dwindle that account, you're talking about a couple $100,000 a year in withdrawals with interest growth and all that stuff. And that's way better than Social Security will be because it'll be gone by then. In addition to that, how many people are born in the US every year? So in 2023, about 3.5 million babies were born. So 3.5 million times Trump's 1,000 would be how much? $3.6 billion. Okay, that's nothing. That's literally nothing in the US budget. Now, the 8,000, call it $10,000. Talking about $36 billion in 1 year. Guys, our entire government spends how much just on Social Security? How much on their entire, we're talking about this would be less than probably half of 1% of the entire US budget. And it would get rid of our Social Security problem for the new generation. This is an absolute no-brainer to me. And the best part is it would be for every child, whether they worked or not. Social Security only goes for you based on what you've paid into it. This would be way better. I don't get why we're not doing these things. The government wants to have their hand in everything. They sit there and say, the haves have, all these rich people have stocks. Why don't you give these people stocks? It's too risky. Well, then why are you criticizing that the rich people have stocks then if it's too risky? It doesn't make any sense. It's absolutely asinine. And I believe these are the kind of changes that are needed. Spoiler alert, these changes won't happen. I love the fact this Trump account thing, it's a brilliant idea. It really is a great idea. And of course, Trump wants to have his name on account for the rest of time so that 100 years from now, kids are like, thank you, President Trump. Just like we'd be like, thank you, President Woodrow Wilson. What was 100 years ago? Who was president? I don't remember. I don't even know. Now, there is one more thing that this article behind me talks about, which I was surprised to see. What it talks about is this is the most exciting time ever seen before in the stock market. Guys, since the April lows, I had to double check this. The S&P 500 is up almost 40% in 6-7 months, the entire S&P 500. And AI stocks have gone completely bonkers. It feels like every company that even mentions the word AI gets rewarded with a stock price that shoots straight up. And that kind of excitement can be fun to watch, but it makes me nervous. Guys, I was just at a funeral today. After the funeral, we had the luncheon. So I'm sitting at the luncheon, my wife's next to me, a bunch of wives and a bunch of husbands there. And we were talking about the trip that we're taking. And in May, we're going overseas for a wedding. So we're talking about, I just bought the flights yesterday, and my friend was saying, yeah, I kept seeing this, the price of the flight go up, so I just decided to get it and lock it in. I said, great. Somebody else said, hey, do you think they're going to use AI to find out the best time to buy flights? Everybody's like, oh, absolutely. I'm like, no, guys, just because it's computer programmed doesn't mean it's AI. They've had these tools for so long to determine the best time to buy an airline ticket. It's not AI. It's just programming. But that was my point. Like, everybody wants to attach every sort of programming now to the word AI. They're like, hey, do you think AI is going to cause this? I'm like, no, AI is not going to cause this. It's just programming. They're just finding trends. That's all they're doing. They've had dynamic pricing in airline tickets since before computers. The airline would be like, oh, it's coming close to the date. We're almost sold out. Let's raise the price. That's not AI. That's just, this is what they're doing. You might want to sit there and say it's AI to feel warm and fuzzy inside, but it's not AI. I see so many people attaching the word AI to anything involving a computer these days, but that's what AI has become. It's become everything. Just like when I watched that 90210 star back in 1999 go on Conan O'Brien and brag about how he had a .com business. And what was it? He was selling plastic protectors for the locks on lockers for school. He's like, yeah, I'm in the .com business. I'm like, no, you're in the plastic protector for locks business that happens to have a website. That doesn't make you a .com business. Right now, the S&P is trading close to a PE of 31. Its 10-year PE crossed over 40 just a week or two ago, and it's now a little bit under 40. Now, guys, another ratio called the price to sales ratio is even worse. What this does, and I talk about this all the time in videos about individual companies, is a way to compare the price of the company to the sales of the company, but this does it for the entire market. We're at the most expensive in history, 3.4. With that said, I want you to realize something. That price to sales ratio should go much higher over time. Because 100 years ago, margins were a lot smaller. You had to spend a lot of money in order to get revenue. That revenue was 5 to 7% was profit. Nowadays, you have companies, like all the big companies have profit margins of 20, 30, 40%. That was unheard of 100 plus years ago when you had factories. So over time, it should be much higher. But it doesn't mean that doesn't make it high. So why is this happening? Well, a big part of it is tech sector. Tech stocks now make up about 1/3 of the entire S&P 500. And it gets even crazier when you zoom in on individual companies. Palantir is trading over 443 times earnings. 443 times earnings. 126 times sales. NVIDIA is over 54 times earnings. These are numbers that simply won't last over the next decade. And if you're a new investor, let me tell you something super important that you need to understand. Price you pay matters, and it matters more than anything that you do. Now, guys, on this board right here is a test I give to pretty much anybody out there that will sit there and talk to me about investing. I give them two companies. I say company A, company B, revenue, profit, and debt. Company A has revenue of $10, profit of $2, no debt. Company B has revenue of $8, profit of $4, but $4 of debt. Which one is the better investment? And I always tell everybody, my only hint I give is it's a trick question. Now, we're going to get 50 or 100,000 people. I don't know how many to watch this video. So people out there are going to get it. But in my entire life, I've only seen 2 people get it right. I was with Goldman Sachs, Harvard Business School graduates in my office once, 3 of them, and they all got it wrong. All got it wrong. This is what I always make fun of. So the question is, which one's a better investment? I asked for comments. People will say, well, this one has a lower margin, but it's got no debt, so this is better. Other people will say, yeah, this one's high margin. They can pay off their debt quickly. This one's better. And then I sit there and say, the trick is we don't have enough information here. What's the price? That's what I mean. If the price of this was $1 and this was $1,000, which one's the better investment? This one is, obviously. Let's switch it around. $1,000 and $1. Which one's the better investment? This one. Price changed everything because price matters more than anything. I want you to remember this. I want you to watch this part. Rewind another minute again and watch it again. This is the most important thing you're going to learn on YouTube. And I guarantee you that all the other YouTube hypers out there, they won't even understand this concept. If you don't understand this concept, guys, just stick to low-cost ETFs, don't look at your brokerage account, and just live your life a merry way. But if you want to be an investor, you have to understand this concept. Now, back to the article. This article also mentions the bubble risk of how extreme stock valuations currently are. Now listen, expensive stocks don't automatically mean we're about to crash. Bull markets don't just end because things get pricey. In fact, bubbles often go much further than anyone thinks they will. Peter Lynch has a great story, and Peter Lynch was one of the best investors of all time. He ran Magellan funds from 78 to 90. He did like 28% returns. He says, I know where the market is based on my cocktail party. If I go to the cocktail party and people are asking me what I do for a living, and I tell them they feel bad for me, it's probably a good time to buy. If I go there and people are kind of indifferent, okay, it's fine. Or they're asking me for advice, it's probably fine. If I go to the cocktail party and people are giving me what stocks to buy, I probably need to be very careful. Because if the average person is asking for advice, probably okay. If they feel bad for him, it means they don't believe stocks are a good investment no matter what. And if they're giving him advice on what to buy, it means things are too easy. So, where do you think we are right now? I'll tell you where I think. When I sit there and I see the bank teller at my local bank telling me that he loves Coinbase and Bitcoin, and that the waitress is buying Bitcoin and buying Nvidia and buying Palantir, that's where I stand. But just because a bubble might be inflating doesn't mean you should stop thinking. This is exactly the time when principle-driven investors need to stay sharp. Because when things get stretched like this, risk is building behind the scenes. And most people don't realize it until it's too late. This is exactly why I don't chase hype. And I'm not loading up on overpriced tech stocks just because they've gone up. I believe in buying great companies at great prices. And I believe that value always wins in the end. We're in a market right now that could absolutely make people rich, but it could just as easily wipe people out. So you've got to stay patient and make sure you're not loading up on overpriced assets just because their price is going up. Remember, we are investors, not speculators. We're not gamblers. The market might be partying today, but we're here to invest for the next 10, 20, 30, 40 years. Guys, one of my best friends in the world, who I love to death, and I hope if he sees this video, he doesn't remember he said this. He was selling his home in Ohio. And I said to him, this was back in early 2010. So like we just had come off the real estate crisis. So people were still worried that there was going to be a double dip of real estate crash and all this stuff. So I said to him, why are you selling your house? He goes, because houses in my neighborhood are plummeting in value and I got to sell before it goes to zero. He stole his house for like $375,000 or something. Nowadays, if you went on Zillow right now, it's like an $800,000 house. Okay. And I remember thinking to myself, like, what is he doing? Because usually real estate's the one area that people don't F with because it's so easy to keep hanging on to something. But then I realized like that's how strong the emotion is when things are going down. He didn't have a ticker on top of his house telling him every single day what his house was worth. He just saw people selling and prices dropping. Instead of sitting there saying to himself, like, listen, I'm here for a long run. I always tell people, if you buy a home, if you put 20% down, it never goes up in value, but you pay it off in 30 years, your equity has probably gone up about 7 or 9% a year. Not bad. Not bad at all. But he wasn't focused on that. The same thing happens in a bear market, but even worse. Why? Because you check your brokerage account. Yesterday, I accidentally checked my brokerage account. I was so mad I did. I was opening it up for something. I hit the wrong button and it opened up my balance. And the reason I don't like it is the balance is up. I don't like looking when the balance is up or down because I don't want to get attached to any sort of number. That's what I'm trying to teach here. What I focus on is, did I buy a good company at a good price? If I did, then the rest will take care of itself. I don't know what's going to happen with Mr. Market up and down, left and right. I have no idea. But what I do know is if I buy a company at a reasonable price and it 10x its profit in the next 10, 15, 20 years, my investment has probably gone up 10x. That's just it. It's just math, guys. With him and the real estate thing, I looked at it going like, you're talking about a house being worth, he literally thought his house would be worth $0. He said, well, Paul, that's where it's going. My house was worth $450 just last year. And I'm like, yeah, but it's not going to $0. How do you know that? I have no answer for that. I just look at it going, because real estate never goes to $0. The land's worth something. Ted Turner bought how many thousands of millions of acres in this country that were uninhabited. He still paid money for it. It still had some sort of value for it. Now, guys, you're on YouTube watching because you're looking for an external factor that's going to tell you what to do or how to do it or why things are going good or bad. But guys, this is exactly why I teach on YouTube. I do that because I'm here to teach a process of thinking. And yeah, that title gets you to watch the video and really learn what's going to really matter. And it might not happen on this first video. It might not happen in the second. But I assure you that if it makes sense to you, keep watching these videos. When you've become really good at this thought process, keep watching these videos. Since I started making these videos, it has reaffirmed the things I believe. It has kept me calm during tough times. That's what's important. So if you ever want to learn how to generate a return above 4 or 5% on the cash sitting in your business and buying great companies at better prices, that's the way you do it. So if you want access to this class, we're going to give it to everybody on the email list first. Click the link in the description below. Make sure you're signed up to get updates in the future. Get first dibs because this option class could be a game changer for your investing. It's something I wish I learned 25 years ago. Now, here's the key. I only want you to buy what you understand. If a company drops in price and you understand what it's worth, that's not a falling knife, guys. That's an opportunity. You're going to hear people talk about catching a falling knife, not if you understand what it's worth. And that's our third principle of principle-driven investing. If you don't understand it, don't buy it. We're not here to guess. We don't follow hype. We value companies, and when price drops below value, we buy. Price, value. We want it here, not here. Now, with that in mind, guys, we do have to make assessment about the future. But if you watch this channel and you watch our other channel, Everything Money Plus, you'll see when we analyze companies, sometimes if it's a newer company, I'll say, guys, I don't know what the future looks like here. This company made 7% last year. They lost 20% the year before that. How do I know what the profit margin is going to be? But in a company like Microsoft or Google or Apple, it's a lot easier to understand that. So this is exactly why I built this channel. I needed to teach this process and this way of thinking that we've called principle-driven investing. We actually have 5 tenets of principle-driven investing, and you heard me mention a few of them already. These principles will protect you from making emotional decisions that could ruin yourself financially. They keep you focused when the world is loud. They keep you calm, and that's when you make the best decisions. If you want all 5 of these tenets, I made it very easy for you. I made a free PDF that you can download right now. It lays them all out simply, step by step. It's totally free. The link is in the description below. Highly encourage you to keep it near you because I keep it near myself and I read it many times per week. Guys, no matter what we talk about in this channel, I'm always going to go back to price versus value. I'm going to go back to principle-driven investing. It's got to be repeated over and over. You've got to do it just like Steph Curry starts every practice with 3-foot shots, not 3-pointers, not half court. He starts right in front of the hoop to do the basics. If you're buying individual stocks, we have those tools. We have that way of thinking. We have the stock analyzer tool. You need to build a watch list. You have to figure out what a stock is worth, add it to your list, and just wait. That takes time, that takes effort, but you'll get the alert when the time is right, and you'll be able to make the right move. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing. for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days, you'll see. This isn't gambling, it's common sense. Look, in the short run, you're probably going to see more hype, and you may even see some panic in the future, but you don't need to react. You can respond with logic, with clarity, with a plan. I want you investing by buying great companies at great prices and not guessing as much. Because while others are chasing stories, you'll be building wealth by being grounded in the numbers and the fundamentals. If you want to see how I apply all of this to real stocks, check out the video on your screen right now. Earlier this year, I picked 7 stocks to go head-to-head with the Magnificent 7 of the S&P. The results will surprise you like they did me. Click now. Thank you for your time.